guys, welcome to another episode of Everything Business. If you're a new time subscriber, I want to thank you and welcome you. And if you are a regular subscriber, then I thank you for returning. So today we're going to be talking about double entry for depreciation. In my last video, I spoke about depreciation and how to calculate depreciation using both methods. So now we're going to look at the double entry for depreciation. Doesn't always come on the exam, but it does come on the exam and it is on the syllabus, therefore it can be tested. So let's get right into it. So then, what are the skills needed to do double entry for depreciation, right? So obviously you would need to know how to do double entry, right? So you would need to know how to do double entry. You need to know how to balance off double entry accounts, right? So if you don't know how to balance off double entry, if you don't know how to do double entry, then you can check in the description below. There is a link to my videos, my tutorials on how to do double entry and how to balance off double entry accounts. You will also need to know how to calculate depreciation, right? Using both methods, single reducing balance method and straight line method, right? Also, there's a link in the description below that can help you to that tutorial. You'll need to know how to do income statement. So if you don't know how to do the income statement, then there's a link in the description below with the tutorial, right? You'll also need to know how to do a balance sheet, all right, or a statement of financial position. There's also a link below to that tutorial. Now, what are the accounts that you'll need, right? Now, generally they will ask for 4 accounts, right? They will ask for asset account, provision for depreciation account, profit and loss account, extract, and the balance sheet extract. Now, the asset account is basically what the asset is, and if you remember, depreciation is really the reduction in value of a fixed asset. So the asset account is whatever the asset is. The provision for depreciation account is really what we record depreciation in, right? It is when you're making provisions, when you're expecting depreciation to be on an asset or to be calculated on an asset. So you record it in the provision for depreciation account. Long ago in the past, they used to have a depreciation account, but they don't have that anymore. So we have a provision for depreciation account, which is a liabilities account, right? And that means that it carries a credit balance. The profit and loss extract, right, is where we would record the depreciation, because depreciation is an expense to the business, and therefore it will be recorded in the profit and loss section of the income statement. And then you have the balance sheet. So these are some important concepts to remember if you are to do well in this topic. You need to remember that asset accounts are normally kept at cost, right? So just remember that at all times, asset accounts are kept at cost. Depreciation is also recorded in a provision for depreciation account, which has a credit balance, right? And what that means is that to increase the account, you would make a credit entry, all right? Or you can say the balance brought down is always on the credit side, or the balance carried down is on the debit side. Those are all other ways to look at to explain, a credit balance. Depreciation is calculated at the end of the accounting period, and this is very important, guys, because the end of the accounting period does not necessarily have to be a calendar year, like from January to December. It doesn't have to be that, right? It can be from March to February, right? So you have to pay attention to dates, and in this topic, dates are very, very important. So please pay attention to dates, and always bear in mind that depreciation is calculated at the end of each accounting period. Depreciation is an expense, as I was saying earlier, that should be recorded in the profit and loss section of the income statement. All right. And accumulated depreciation is the sum of all depreciation calculated on a fixed asset to date. All right. And so we are going to be looking at accumulated depreciation when we reach to the balance sheet extract. But you need to know what accumulated depreciation is. All right. So remember these concepts, and you should be fine in this topic. So let's look at a practical example. Now, a tractor is bought for $6,000 on January 1, 2020. It will be used for 3 years and then sold for $3,072. You are asked to show the following accounts for the 3 years: the asset account A, B, provision for depreciation account, C, profit and loss extract, and D, balance sheet extract. And they said that we should use the reducing balance method of 20%. So let us look at the first one, the asset account. Alright, generally in the exams, as I said before, they ask you for these 4 accounts. Alright, so you need to know how to record in these 4. So A, the asset account. Now this is what the asset account would look like for 3 years. It can get a little bit more complex than this if you have more than one assets being bought in different years, or if you have more than one assets being bought overall, right? But this is really a basic example. This is really how it will look basically, right? Now we are only dealing with one asset here. Now if you look at it, the asset was bought on January 1, 2020. I want you to realize that I have my dates in, right? This is my asset account, debit side, credit side. It's an asset account, therefore to increase an asset account you would make a debit entry. So on January 1, they did not state what we use to buy the tractor, whether cash or check. Therefore we're going to just assume that it is bank, and you write this check and you write bank here. So you have bank $6,000, right? And for 2020 we did not buy any other asset for 2020, and so we are going to balance off the asset at the end of the period, and this is where the balancing of skill would come in, right? Again, I said if you do not know how to balance off a double entry account, then look in the description below and you can see the link to that tutorial. So you balance off the account for 2020. You have a balance carried down here, right? And because it is one item, one line, the item, the entry is in one line, then we can just double line it, right? Then we carry down the balance brought down for the beginning of the next year, January 1, 2021. I want you to pay attention to that. At the end of 2021, which is December 31, right, we did not acquire any additional asset, and so we'll balance off the asset account, right, for the end of that period. Bring down the balance to January 1, 2022, and I want you to bear in mind that the asset account is also kept at cost, right? So this is the balance on the account at the end of 2022, right? We didn't buy any more assets, therefore we balance off the account and it still remain at cost. At January 1, 2023, the amount is $6,000. So basically you're just balancing off the account every year. You don't buy any new asset, right? So it will always remain the same, right? If you had bought a new asset though, right, then it would have thrown a new spin in it. The only thing that would be different is that the balancing off would not be that easy, because then you would have to add up the assets, you know. But apart from that, it's the same principle that would apply. So that's A. So let's look at the provision for depreciation account, which is which may be one of the more challenging accounts, because it is that account where you would have to do your calculations. So here is a provision for depreciation account. So the provision for depreciation account is where you would record depreciation. It carries a credit balance, right? Therefore, to increase the account, you would make a credit entry, right? Now, what I normally tell my students is that, all right, when you're doing your provision for depreciation account, especially if you're asked to use the reducing balance method, right, which is not as straightforward as the straight line method, you can check in the description below for the link to that tutorial. It's not as straightforward as the straight line method. Then I encourage my students to do their working out first, right? So you do your working out, as you can see here, you get all of your figures, you get all of the numbers, everything. Now, I want you to pay keen attention to this. Dates are important, so you'll realize that I have in my dates here. All right, good. Depreciation is calculated at the end of the period, right? Therefore, you will see for December 31, 2020, right, it's on the credit side because the provision for depreciation account carries a credit balance. Therefore, to increase it, we would make a credit entry. Depreciation is also an expense, right? Therefore, it should be in the profit and loss section of the income statement. That is why I have profit and loss here. So 2020, December 31, which is the end of the accounting period, profit and loss, right? Because depreciation is an expense. And the question did say 20%. So 20%, as you can look over here on my working out table, right? I found the 20% of 6,000, which is 1,200. That is the amount for depreciation for the first year, which is 2020, and I record it here. Now, I do not have any more depreciation for 2020. Therefore, I will balance off my provision for depreciation account for 2020, right? So it's still 2020, still the end of the accounting period. Balance carried down on the account was 1,200, and I double line because the items are in the same line, right? And it's just one item, right? So I balance it off, I double line, and then the balance on the depreciation account will come down here, right, on the credit side, because the account carries a credit balance for 2021, January 1, 2021. So the balance on the account is 1,200. At the end of 2021, December 31, right, we have to calculate depreciation again, because depreciation is calculated at the end of the period. So if you look at my working out table year 2, I will find 20% of the reduced balance, which is the major principle or characteristic of the reducing balance method. In the years after the first year, you calculate the fixed amount or the fixed percentage on the reduced balance, which is in this case 4,800. So you calculate 20% of 4,800 and you get 960. So then the depreciation in the second year, right, is 960. So you would put it here. Then now you'd have to add it. So 960 plus 1,200 give you 2,160. And that is how we balance off the depreciation for the second year. So at the end of 2021 again, right, you have December 31, the balance carried on, the balance on the account 2,160. You bring down the balance again for the next year, which is 2022, January 1, right? This is the opening balance, 2,160, which was the balance carried down. So I want you to pay attention to that. All right, so we have to calculate depreciation again for 2022, which is the third year, right? Again, this depreciation is calculated at the end of the period, should be transferred to the profit and loss account because it's an expense, and you find 20% of the reduced balance, which is now 3,840. 20% of 3,840 is $768, right? And that is the depreciation for the third year. And if you had more years, you would just continue in the same vein, right? Same procedures. All right. So the profit and loss extract. Now, if you look back at this, right, this provision for depreciation account, you would realize that we credit the provision for depreciation account, right, with the profit and loss, right? I will say, December 31, profit and loss, 1,200, all of that, right? It therefore means if we're following double entry principle, it means that the profit and loss account must be what? Did you say debited? Very good. So the profit and loss account must be debited, right? Because it's an expense, right? So the profit and loss account is going to be debited with the provision for depreciation account, showing the double entry. So for each year, you have December 31, profit and loss, provision for depreciation account, and you put the amount for depreciation there, right? So you can look back at your provision for depreciation account, the 1,200 there, the 960 there, the 768. You will realize that it is the same amount, the same figures that we have here for the various years, and you just double line it like that, and that should be okay to get full marks for the profit and loss extract. Remember, it's an extract, which means you are taking out a part of it. It's not the full profit and loss account. And then the last account, which is the balance sheet extract, right? This is where the accumulated depreciation concept will come into play. Now, the balance sheet extract, right, you maintain it again for different years. So you have for 2020, for example, you have the tractor at cost, which is $6,000, less the accumulated depreciation. Accumulated depreciation is the depreciation, as I said before, that has added up on the asset over the years. But because this is the first year, there is only one depreciation that has been calculated on the asset, which is 1,200. So you will only use the 1,200 here. A trick that I normally teach my students to use is look back at your provision for depreciation account, as I have here, right? Look back at it. All of the balance carried down would be your accumulated depreciation. All of the balance carried down. So the first one in the first year, December 31, balance carried down was 1,200. Then that would be the accumulated depreciation for the first year. In the second year, right, balance carried down was 2,160. Then that would be the accumulated depreciation, and in the third year, and so on. So you always subtract your accumulated depreciation from the cost of the asset, right, to get the net book value of the asset for that period. And that is what we keep doing every year, and that is how you do the balance sheet extract, and that is how you do double entry for depreciation. Thank you very much. Wow, good.